Hello, and welcome back to another session of Reflections on Investing with the Cornell Capital Group. And last time we talked about PE ratios, in particular the forward PE ratio and what it implied for the market. And I got some pushback on that. People said, why didn't you use Professor Shiller's CAPE ratio? Isn't that better known? Isn't that more relevant? And they have a point. But the reason I didn't use it was because Professor Shiller's CAPE ratio is often presented in a host of different ways. For example, many people say it's the ratio of the level of the S&P 500 to an average of the last 10 years' earnings. That's not quite right. So I thought in this session, what we do is go back to Professor Shiller's actual work product and see exactly how he does it. So let's get started. Let's go to the computer. And here I have a Google search window, and you can see I've done it before, but I will enter Shiller data. When I do that, it brings up this page, Robert Shiller online data. So I don't think you can see my cursor, but if I click that, it goes to online data, Professor Robert Shiller. And down here you'll see U.S. stock markets 1871 to present and CAPE ratio. So if you click that, what happens is that you are automatically downloaded a spreadsheet called, you can see it, well, you can't really see it here at the bottom, but it's called Shiller data. So you now have the actual underlying data. So let's go there and take a look at what's in that spreadsheet that you just downloaded. And here is the first thing. It's Professor Shiller's CAPE ratio graph. And you can see from this that it's very high in 1929, 2000, and this is 2021. So those are the three peaks. And you can also see, relevant to what we talked about last time, that it's dropped sharply in the first 6 months of this year, down to 28.9. Still above the long-term average of about 23, but a good deal lower than the nearly 40 that it was at the start of the year. And as I explained in the last version, much of that is because current earnings are so high. Now, as you're going to see, the Shiller CAPE ratio is less influenced by current earnings, but still earnings over the last few years play an important role. So this is Professor Shiller's graph. Now, how actually does he calculate it? And if we go to the spreadsheet data itself that you can get from Professor Shiller, and let me explain the columns here. The first one is just the date. It's year dot month. For example, this is March 2022. And at that time, the S&P 500 was 4391.27. And the monthly earnings on the S&P index were 197.91. Now, Professor Shiller does not work with the nominal or current dollar value of the index. He's aware if we're going to average earnings going back, we can't mix apples and oranges. And the way to avoid that is to adjust for inflation. That's why he has the consumer price index here as another column. So what he effectively does, he starts with the current data. For the level of the index, for example, it's 38, 31, 39. And that's both the current level and the real current level. But as we go back in time, he adjusts for the increasing purchasing power of the dollar. So, for example, in September of 2021, the S&P 500 index was 44, 45, 54, but adjusted for inflation, it's 47.75.77. Professor Shiller does exactly the same thing with earnings to get real earnings. Then what his CAPE ratio is it's the ratio of the current real level of the index. That's column I, and if you can see column I up here in the average bar, and the formula bar, divided by the average of the last 120 months of real monthly earnings, or 10 years. And that happened to be in September of 21, 3762, and the most recent, as shown on the previous graph, is 2890. I know that's a lot. It's quite a mouthful. But to the extent that you want to use the Shiller CAPE ratio, it's important to use his actual data. So the one thing we recommend here at the Cornell Capital Group, if you're going to use an indicator in making your investment decisions, like the Shiller CAPE ratio, it's a good idea to go back to the original source and make sure you understand exactly what it is and how it was calculated, so you won't be misled and maybe make an incorrect decision on that basis. This has been Reflections on Investing with the Cornell Capital Group. Thank you for joining us.